All right, let's go ahead and get this started. My name is Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive technology stocks for a broad audience of retail and institutional investors. Today, we're going to talk about a company called Plug Power Stock. Now, the title of this presentation is a bit clickbait, so it says why we're not buying it. So does that mean we're not buying the stock? We're not buying the hydrogen thesis? Well, it's actually a little bit of both, though there have been some green shoots lately that we're going to talk about today. So we'll start this presentation out by looking at a headline, and we're just going to read this headline verbatim because it's quite good. This is from Fortune. So it says, "Meet the new market makers. They're young, they're rich, and they couldn't care less about Graham and Dodd." So Graham and Dodd are Columbia Business School professors that would probably be considered the fathers of value investing. That is, they suggested investors should look at the intrinsic value of a company as opposed to the share price. So the headline continues, but they're the ones driving those insane tech stocks and they're not going away. So this rings true when you think about a lot of the headlines that have been published about the Reddit types and meme stocks and how all these retail investors with their $240 balances over at Robinhood are sticking it to hedge funds, when in fact that couldn't be further from the truth. So this headline rings quite true, and in the article it talks about how this lady is on the floor with this trader, not like that, but on a trading floor with the trader, and they're discussing these stocks that are shooting to the moon, and she says, "What's this stock you're looking at?" And he says, "It's Plug Power." She says, "What does it do?" And he says, "I don't know, does it matter?" And everybody has a good laugh. So in the piece they talk about Plug Power hitting $79 a share. Well, if you look at the last time the hydrogen fuel stock thesis peaked, this was in January of 2021, and in the upper right hand corner you can see Plug Power that certainly didn't, looks like it barely crested $60. Well, in fact, Plug Power's 52-week high is somewhere around, let's say, $71. Well, the title of this article that we just talked about, this was actually published in the year 2000, and it was about Plug Power, and interestingly enough, the share price was about the same. Now, what what's interesting is that Plug Power since then had a reverse split. So at that time, that share would have been trading at about $1,500 a share. So it was truly hyped. And when the piece says they're not going away, well, guess what? Those traders went away in a hurry, because when the dot-com crisis happened, if you had a $100,000 portfolio at the peak, even if you were invested in stocks like Cisco and Intel, you would have lost 80% of your money. You would have had $20,000 in about a year, and it would have taken about 14 years to recoup that money. That is, if you didn't sell at the bottom like a lot of people did. So history repeats itself, except today, Plug Power is a little bit of a different company. And why is that? Well, it has what we always look for, and that's growing revenues. So here you can see for 2017, 18, and 19, a nice steady growth there for revenues. But suddenly in 2020, we see negative revenues. Now, this took a little bit of investigation because negative revenues don't make sense. So we dug into their 10Ks and 10Qs to figure out what's going on. And it surrounds a relationship that they entered with Amazon back in 2017. This likely made the headlines, with firms talking about how Amazon was acquiring 23% of Plug Power and all that. But here's what actually happened. So try to keep it simple. Plug Power said to Amazon, "We're going to give you 55 million shares after you spend $600 million with us." At the time, that was about 23% of Plug Power. And it wasn't just, "We're going to give you shares at today's price or at the price of whenever we decide to give them to you, whenever they vest." It was shares at a significant discount. So anywhere from $1.80 to whatever, $10 to a volume weighted average. It's all there in the terms, but if you averaged it out, it might come to be around $6 a share. So the conditions were this. So tranche one, that vests right away. That's just for admin costs. Tranche two, That vests in 4 installments, each vesting when you spend $15 million with Plug Power. Amazon gets that portion of shares. And then tranche 3, same thing, except 8 installments, and each of those 8 vest when they spend $50 million with Plug Power. Okay, that's great. So the Amazon has been given a real incentive to spend $600 million with Plug Power. That was what, 5 years ago now. So what actually happened? Well, first of all, we need to, this is an important point to make. Between that time and now, 2017 and now, the outstanding shares for Plug Power have nearly tripled. So this is a big red flag. Investors, retail investors in particular, don't pay attention to outstanding shares. And this is a very easy way for a company to keep giving parts of itself away in exchange for cash or whatever, and to get Amazon on as a customer for whatever reason. So Plug Power's shares outstanding nearly tripling in what, 4 years time. That's not good. So that's one red flag that we came across that's worth noting. Now back to talking about Walmart. The question is, how much money since 2017 has Walmart spent with Plug Power? That's a good question to ask. Well, we dug into the 10Ks. It's not explicitly stated, but we're given percentage terms, and then from those we can deduce the revenue that these firms spent. Now, 2 big customers for Plug Power are Walmart and Amazon. That's great, right? Well, that's a double-edged sword. So let's look at Amazon here. We were able to deduce that Amazon spent, in the bottom table here, 42.4 million in 2017 and 38.5 in 2018 and 89.6 in 2020. Well, if you combine those, and for the years that are unknown, let's say 2019, because we're assuming that Amazon didn't have meaningful revenues in 2016 where they would have listed them as having a meaningful percentage of overall revenues. Let's say Amazon spent let's say 100 million in 2019. Well, if you add all those numbers up, Amazon still hasn't spent $600 million. In fact, they've spent about half of that so far. That's what you would get. Now, what happened in December of 2020 is quite remarkable. So Plug Power said, we're waiving the remaining vesting conditions under the Amazon warrant, which results in immediate vesting of all of Amazon's warrant shares. So let's say Amazon had only spent half the money they were supposed to receive those shares, those discounted shares. They received all of them anyway. Why? It's really difficult to say. We talk about big swinging dicks, and that's what Amazon is. And when they sit down at the negotiating table and they say what they want, they get it. So maybe they just wanted the rest of those shares. And the CEO of Plug Power was quoted by Wall Street Journal saying that it was an extraordinary payday for them. And that's great that they could give Amazon that big payday. And then a follow-on article by the Motley Fool said that Amazon is in fact not holding those shares. They liquidated them, so they received the shares at about $6 a share. The current price today is what, mid-20s? They liquidated those, captured the difference, and made away like bandits. So let's just forget about that now. That's in the past, and let's look forward. Now, the bull thesis for Plug Power is everywhere. You're going to hear that from all the pundits. Morgan Stanley set a $65 price target for Plug Power, and anybody that works in finance knows that the credibility of investment bankers when it comes to price targets is zero. So take that for what it's worth. There's a great 75-page presentation that you can avail yourselves of and learn about the bull thesis. We've been hearing about it for decades. They're going to expand the use cases to trucking. They're going to build their own hydrogen plants, and that's partially because they're having problems with their suppliers. And they've got this grand vision of a hydrogen economy. And frankly, it sounds great. They have growing revenue streams. Everything's looking pretty good. And what you'll hear now are the cheerleaders saying things like, well, now you have to enter into a position because this is the lowest price that you'll ever see shares and whatnot. And that's never true. So when you have a lot of volatility, such as we're seeing today, there are going to be a lot of potential entry points for the stock as time goes on. So if you reverse out the negative revenues that they recorded for 2020, they have around 306 million. And if you look at a chart of their revenues over time, which we didn't include in this deck, but if you go to the research piece that we published alongside this presentation, you'll find it there. It shows this beautiful trajectory of revenues. So that's certainly quite appealing for Plug Power, and we don't need to talk about the Bull Thesis because everybody else has. Now, when you look at their plans going forward, they're building these hydrogen plants, and that's one problem we noted is the reliability or the reliability of hydrogen at a particular cost. So they're having to deal with third parties, and it hasn't been working out so well. So now they're going to start, creating their own fuel, and that's great. Fuel is a very small percentage of the overall revenues right now, somewhere around 8%. And here's a nice breakdown of their various service lines. So there's certainly, there's this big plan that they have now when it comes to the valuation of shares. Shares of Plug Power since that peak in January 2021 have plummeted about 68%. And that's the norm for Plug Power. It goes up and it goes down. Now, if you look at the market cap of the company, divide that by annualized revenues, that's last quarter revenues times 4, it's not overvalued. So when we consider companies to be too overvalued to buy, they'd be at around a simple valuation of 40 or higher. So we won't buy companies that are that high. In the 20s, that you could argue it either way. You could say it's overvalued. Well, compared to what? Well, then you can start to run this ratio on other companies and see. But in our experience, we wouldn't say Plug Power is very hyped right now. So it comes down to, would you buy Plug Power stock? Would we buy Plug Power stock? Well, let's just set the hydrogen economy thesis aside, because there could be a good debate to be had around that. And let's say that they're going to make progress in what they're doing today. So they're primarily working on forklifts and materials moving equipment. So let's say that they make progress there. We would need to see that Amazon and Walmart are becoming less and less of a big percentage of the revenues over time. That's critically important. You can see, as we've talked about today, look at their decision to waive Amazon's remaining vesting conditions. Does that seem right? No, it doesn't. You know what it seems like? It seems like shareholders are subsidizing Amazon, the biggest company in the world, to adopt this technology. And in exchange, they're being diluted to no end. So this doesn't seem like a fair deal for shareholders. And pundits have expressed varying opinions about that, but nobody seems to be able to formulate a good argument as to why this has panned out the way it has. Maybe you could say, well, they're trying to get a flagship customer on board. Great. Well, let's start seeing the other customers come in. So until Plug Power provides specific customer concentration information like every other firm out there does, typically they'll go down and you scroll down the 10K or the 10Q, and they'll come to a section where it says whether or not a customer has more than 10% of total revenues, and they don't even have to list the customer ABC, and they'll spell that out. We don't find that for Plug Power. We had to do a lot of digging just to come up with what we did. So we need to see the customer concentration information before we're going to do anything. Without that, we don't know what's going on. We need to make sure that these big 500-pound gorillas like Walmart and Amazon aren't calling all the shots, that Plug Power could have a business without these two large companies. So it's worth noting that Walmart has almost exactly the same set of conditions that Amazon has. All right. And that's probably the topic of a whole nother presentation. Almost exactly the same conditions that Amazon has that were granted in 2017, months after Amazon was granted theirs. So it remains to be seen if we're going to see if Walmart says, hey, I want equal treatment. And we're going to see more of this negative revenue bit. But what's most important is that we see the percentage of revenues coming from both Walmart and Amazon decreasing over time. And unless the company gives us visibility into that, We don't know that's happening. So there are a lot of pros to Plug Power. It's great to see that they're having growing revenue streams, no matter how they've worked to get those. It's great to see that the progress that the company is making. As with any other company, they have ambitious growth plans. Those are great too, but we don't invest in stories. We invest in what's happening right now. So we need to see this customer concentration information from Plug Power. Once we can see that, we see that they're having less reliance on Walmart and Amazon. We'll take another look at the company. So thanks so much for taking your time to join us today. Much appreciated. Sign up to our channel. We'll be putting out more videos about all kinds of topics, specifically around green technology, synbio, space stocks, things like that. So thanks so much for your time. Much appreciated.